In this module, we're going to be talking about one of the central aspects of any private equity transaction, which is due diligence. There's almost no investment transaction that will take place without due diligence, and therefore this is a central pillar of the private equity investment process. As an advisor, it's possible that the professionals, accounting and other professionals, may find themselves playing a variety of different roles when it comes to due diligence. One role may simply be that they may end up working for an investor on the buy side due diligence. In other words, working for the private equity investor to produce reports and analysis for the purposes of the investor's due diligence. That's one role. The second role is that the advisor may be working for the company performing so-called sell-side due diligence, which is a type of due diligence which we do in anticipation of a potential transaction. Or it could be that they are part of a firm which is asked to provide an opinion on a set of financial statements without performing an actual due diligence. In the case of an advisor working for the company, this is where sell-side due diligence is going to be one of the central concepts which we're going to be covering. And part of an effective sell-side due diligence for any advisor working for a company is firstly the ability to persuade the company and its owner that a sell-side due diligence is a worthwhile investment. And then secondly, performing an effective sell-side due diligence which can then synchronize with the buy-side due diligence of any investor. And that's the second key success factor. The objectives of the module are to describe sell-side due diligence as a pre-investment process, to present sell-side due diligence as a roadmap to facilitate buy-side due diligence by an investor, how to manage due diligence cost management and apportionment of cost among the interested parties, a description of consultants working in due diligence and broking of private equity transactions, and lastly, best practices in due diligence reporting. One question that's commonly asked is at what point in the transaction, the private equity transaction, does due diligence actually start? Well, we have to look at two key important points. The first point is whether we are talking about buy-side due diligence or sell-side due diligence, and they'll have a different kind of starting point. And the other thing we need to talk about is the fact that before the formal due diligence, which can be defined as that where we are starting to pay third parties, such as accountants and lawyers, to produce work, we also have a pre-due diligence phase. And there can be some overlap or grey area between the two. So let's look at this. Buy-side due diligence will start once the investor has commissioned external advisors to begin the due diligence. So the starting point is simply the moment at which these advisors are appointed and are starting to get paid. However, there will also be a grey area where the investment officer of the private equity fund may perform other types of due diligence, primarily business due diligence, ahead of this in order to establish whether it's worth going on to the next level. And this could be defined as pre-due diligence. And it's basically mostly going to be centered around business, but they may have a look at the accounting and legal situation, if only to map out what they need from their advisors. On the sell side, it's not so structured. The sell side due diligence can be performed at the leisure of the company because there is no time pressure conditioned by deal milestones, as in the case of buy-side due diligence. So the sell-side due diligence could be performed in bits and pieces over a period, the main condition being that it should be ready ahead of the time that negotiations begin with a private equity investor. A good way to understand what a financial due diligence is to consider the analogy of buying a used car. As the purchaser, you may be able to obtain certain documents that provide you with some comfort that the car you are considering to purchase is in good condition, at least relative to the price you are paying. For example, the car may have a warrant of fitness or some other document certifying its roadworthiness, or you may have records provided by the vendor that outline repairs and service work performed. Although you may find some comfort in these documents, you are likely to want to perform your own due diligence, looking the car over, taking it for a test drive, and kicking the tires. However, If you are not a mechanic, you may not be able to really make a good assessment, so you may want to hire an expert who is a mechanic to make a more informed and thorough assessment of the car, someone who can focus on your concerns and look more closely at matters that may be important for whether or not you eventually purchase the car. A similar analogy can be applied for a house purchase, where often performing an expert home inspection forms part of the outstanding conditions in a conditional sales and purchase agreement. In the case of a financial accounting due diligence, the mechanic is most often a qualified accountant working in an accounting practice. Although a financial due diligence may be a source of comfort in a private equity transaction, it is not an audit and does not provide any opinion as such. So let's look at a few important differences between an insurance engagement, let's say an audit, and a financial accounting due diligence. Who performs an audit is often subject to state regulation. Some shareholders rely on the company auditors to add credibility to the statutory financial statements, and so it is important they are independent and competent. On the other hand, performing a financial due diligence could be done by anyone, including finance staff currently working in the target company. However, in practice, this work is performed by professional accountants that have developed experience in these transactions. On what? Assurance engagements typically involve historical financial information, although it is possible to perform an examination of prospective financial information. This is not common. However, in a due diligence, the role of prospective financial information is significant, and looking at the mathematical accuracy of computations, as well as the assumptions underlying the numbers, can be important. Although audited financial statements provide information that can help investors, shareholders to hold, sell or buy their shares, such information is generally not provided in contemplation of a potential transaction, which is the case for circumstances under which a due diligence is performed. Financial statements do not alone provide the information investors need when assessing an investment opportunity. The objectives of each are indeed different. What governs the work performed for an assurance engagement is determined by the relevant standards, such as the international standards on auditing for audit engagements, or the international standards of review engagements for limited assurance engagements. Laws also play a key role for performing audits and reviews. For an accounting due diligence engagements, there are no standards issued, and the work is governed by what is agreed between the client and the team performing the work. In terms of outputs, for an audit or review, there is a requirement to issue an opinion, modified or unmodified according to the standards, whereas for a due diligence, the work is usually communicated through a report. However, a due diligence engagement could conceivably be communicated as a presentation. Although accounting due diligence areas of focus may vary considerably, much more than with statutory exercises, some of the typical areas might include the following. Looking at the quality of the earnings. So due diligence will assess whether the earnings are maintainable or whether there are significant one-off items, such as, for example, the sale of a building, or whether some of these earnings are distorted by goodwill or accounting manipulation of some kind. Another area is to identify some broad trends in the financial operations, and part of that may be by making use of ratio analysis. The trend might be whether the sales are growing or whether the margins are deteriorating over time, for instance. Another third area might be to analyze working capital to see if the company's working capital situation is satisfactory, or whether there may be some issues like, for instance, a build-up in inventory or some slow-moving inventory, for example. Fourth area would be to look at the key assumptions in the management forecasts. The management will have prepared a forecast plan, and some of the assumptions may be something that could be challenged. It could be that there's over-optimistic growth in sales, or the market is assumed to grow too quickly, or there's some assumptions about efficiency which may not be backed up according to historical performances. Fifth, could be to analyze litigation and regulatory issues, whether there's been any outstanding litigation on the company or whether there are any regulatory judgments which may impact the company going forwards. And regulatory issues can be very important, particularly in regulated industries such as banking or telecoms. Another area would be to assess the accounting resources and systems. Does the company have a strong management information system, like a computerized system that can easily generate monthly reports? Is the bookkeeping system sufficiently computerized? And these will be also something to do with the process quality, which will also be assessed. And then there may be a number of other areas which may be agreed ad hoc between the seller and the buyer, according to the sector and the different types of companies that may exist in the market. How to report on due diligence findings? Well, there's no specific template or regulatory requirement for how the report should be done. In practice, different accounting firms will use their own different styles, and so it is possible for the investor or the sell side advisor to give guidance to those performing some structured due diligence on how they would like the report formatted. But normally there would be an executive summary, a main body, and some appendices. Like any good report, people want to have a quick overview in the executive summary, and then some of the more detailed information will go into an appendix. And obviously, a user-friendly layout, like any document, would be very important. Sell-side due diligence, pre-investment. A few words to introduce the topic of sell-side due diligence. Many private equity and indeed other deals tend to be derailed when a surprise emerges from the sell side during the investment process, because this makes the buyer think what else may be there. By doing an internal homework ahead of time, the sellers can enhance value and improve negotiations, because the buyers will have a higher level of confidence that any surprises are not present. If a seller does not do a sell-side due diligence and an issue is identified by the buyer and the seller indeed was not aware of it, which happens, this can put the seller in a very defensive position as regards to the terms of the deal and put them at a strong disadvantage. A surprise emerging when the buyer performs due diligence tends to wipe out the credibility of the seller, because the buyer then questions how much else is there. Doing a sell-side due diligence allows the buyers to actively identify matters impacting value because they've been flagged, and what this does, it minimizes the uncertainty of the process and increases the value of the investment. From a more technical point of view, the objectives of due diligence include forecasting the future performance of an organization by looking at the potential risks and threats that are present at the time of the investment, and to identify any problems which may create unanticipated liabilities in the future. As we can see, the chart on this slide summarizes many of the areas. As we can see, due diligence is widely encompassing of several areas. It goes from the main risks, so risk analysis, an examination of the balance sheet, looking outwards at competitors in industries, looking at the company's capital structure, looking at the management of the company, and many other areas. Some of the reasons for conducting a due diligence, or some of the things one is trying to look for or assess the level of, will include the hidden risks which may be attached to the transaction, looking for the skeletons or the secrets which most businesses tend to have, either explicitly, inadvertently, or deliberately, and finally to assess the level of the company's corporate governance. What is a sell-side due diligence? The seller takes a critical look at its own financial position and assesses the risks and opportunities the company faces prior to seeking an investor. So it's an exercise done by the seller for himself, looking forward to a potential negotiation with an investor. The area of focus of the sell-side due diligence will be mirroring the objectives of the buy-side due diligence. In other words, anticipating the different areas where the buyer may perform due diligence. Technically, this means analyzing earnings, looking at the credibility of forecasts, looking at working capital requirements, looking at tax risks, customers, suppliers, and other key relationships and contracts the company may have. The sell-side due diligence would be performed early in the investment process, ahead of the buy-side due diligence, whereas the buy-side due diligence would be one of the later steps of an investment process, typically performed after the term sheet has been signed. The sell-side due diligence report that would be produced by the advisors may be provided to the potential investors in order to assist them in understanding and to provide them with a roadmap to make their buy-side due diligence more precise, more efficient, and more cost-effective. Obviously, they would have to sign a non-disclosure agreement to protect some of the confidentiality of the information contained in a sell-side due diligence report. The buy-side due diligence is performed by the investor and the different advisors working for the investor. This buy-side due diligence, in the case of multiple investors potentially looking at the company, would not be shared with the other investors, so it would be proprietary to the investor who had commissioned it. This buy-side due diligence may be partially shared or fully shared with the seller on certain conditions, but it will depend on the cost arrangements between the parties for the buy-side due diligence, the level of due diligence, and any sensitivities that may come out from it. As far as the depth, it tends to be a more in-depth exercise than a sell-side due diligence, and therefore with a consequently higher cost as well. There are, broadly speaking, 5 main types of due diligence. Business due diligence, which refers to a review of the business. Legal due diligence, which refers to checking out the legal aspects and the level of legality of the company. Accounting due diligence, which focuses on the financial statements of the company and assesses whether these are of a level sufficient to be credible. Technical due diligence, which may be performed in the case of assets of the company which require technical review. And environmental, social and governance due diligence, which refer to whether the company is environmentally sound and is respecting good social and governance norms. Looking at some of the features of the due diligence, the business due diligence is performed generally by the private equity fund manager themselves. They may sometimes use third-party contractors for specific things, such as doing market research or investigating the background of senior managers, for instance. It's a general wide-ranging review, analysing the business plan, looking at the company in the market, potentially talking to suppliers, customers, and even competitors. Legal due diligence is a structured exercise performed by a law firm. Typically, it will be including whether the company owns its assets, if there's any outstanding litigation, whether all the company's permits are in order, and all the key agreements of the company are properly legally executed. An accounting due diligence is performed by a firm of accountants, and it will consist of reviewing the historic accounts, either at a limited level or at a full audit level, depending on circumstances, and it may also extend into helping to review the financial section of a business plan, such as the forecasts. Technical due diligence is performed by a specialist firm, often engineers, and this will involve inspecting and potentially valuing technical assets and systems of a firm or a factory which may have assets which are difficult to assess without bringing in an expert. Environmental and social due diligence is often done by specialist firms, checking if the assets and the processes comply with relevant environmental regulations. So business due diligence is performed by the investor directly, so the members of staff, although in some different markets it may be subcontracted to some extent, or with larger deals it may be subcontracted. So it includes analysing the business plan, background checks of management, interviews with key stakeholders, and a general research in the market, and potentially other types of research as well. Here are some examples of business due diligence and some of the outcomes that can come from a satisfactory business due diligence. In the first example, it turned out that some of the customers had been pre-selected by the seller and coached to tell a specific story to the investor, who then noticed it and then insisted on speaking to other customers and discovered a different picture. In another case, the company had all its permits and contracts in place, and the seller was reluctant to allow the fund manager to talk to the city authorities who issued those permits. When they found a way to talk to them, they discovered that there was going to be a change in regulations which would then impair the business. And thirdly, it can also be the case that the seller is not actually aware. In the case of the tobacco investment, the fund was doing their buy-side due diligence and went to talk to some of the big advertisers who were placing ads for cigarettes on these magazines, and discovered they were planning to discontinue these. And in fact, the entrepreneur was unaware of that because he hadn't been in regular contact with them. So it can also be an accidental discovery. Legal due diligence is performed by a law firm. It's very rare for the fund managers to try and do it in-house. It has happened in some smaller cases where they may have a lawyer as part of the team, but it tends not to be very effective that way. It consists of a legal review of the company, and some of the main items they will check is whether the company has legal title to their assets. So do they own their assets? Is there any outstanding litigation? And what is the potential amount of that? Are the operating and other permits in order, up to date and legal? Reviewing key contracts and arrangements, such as contracts with suppliers, customers, managers, employees, and others. And checking the regulatory environment and its potential impact on the business. So in the case of a regulated business, to review the likely changes in the regulatory environment and their potential impact. Here are a couple of examples of legal due diligence. In the first example at the top, the due diligence was being performed on behalf of a debt provider who was planning to provide the company with some long-term debt after the private equity fund had made their investment. And one of the happy discoveries made by doing that legal due diligence that had not been discovered before was that the telco, the national telecoms company, did not own the tubes in which its cables were laid, giving therefore access to the tubes to the cable TV company. In another example, we had a situation where the telecoms company was lobbying the city to change the regulations concerning access to heating tubes in order to block the cable TV company from putting their cables in it. And they did that by engineering a bylaw according to which people were not allowed to put technical equipment into these tubes because it would damage the tubes, so they said. And the cable TV company was using a kind of mechanical robot to pull the cables through. And after this bylaw came out, they found a very ingenious solution involving a dog, and therefore were able to circumvent this bylaw. Accounting due diligence. It's generally performed by an accounting firm, and it consists of a financial review of the company. So it's a fairly straightforward and clear exercise, and this means it could either be a full audit or a limited review. There may be some special analysis of areas of uncertainty, depending on the sector. It could involve preparing financial statements, so reclassifying financial statements which are not prepared according to international standards, and reclassifying in a way that's more intelligible to the buyer, and potentially also reviewing the financial section of the company's business plan. Here we have a couple of examples of accounting due diligence. In the top example, the accounting firm proposed a full audit, but the fund manager declined and decided to do a full audit only of the payables and receivables, which were the main areas of concern. And great thanks to that, they saved 75% of the original quotation. Sometimes things can go very wrong. This happened in a major Mediterranean country because the due diligence was not very well managed, and they decided to leave to a very late stage the visit to a brewery in the south of the country. They then discovered there was actually no plant, and this exposed a major shortfall in the balance sheet of the company, and clearly the deal then collapsed. Technical due diligence, almost always performed by a specialist consultant hired for the purpose, generally consists of an on-site inspection of technical assets and systems, the condition of these systems, the valuation of the asset, potential improvements in case of weakness. The example shown on this slide was that management wanted to buy a new bottling line for their brewery, but the expert commissioned by the investor concluded that all was required was to spend a small amount of money to refit the existing line, and it could continue, and therefore that enabled the investor to have a very substantial cost saving. Environmental due diligence, similar to technical due diligence, is performed by specialist consultants, and the broad objective is to check whether the company's assets and processes will comply with environmental regulations, be these local, national, or supranational, such as EU level regulations. And again, these costs can be managed. There was an example of an investment in a chain of 30 gas stations, where the investor decided to ask the environmental specialist to only do a full inspection of two of the 30 and see what results that would give. And when it turned out that everything was satisfactory, they were able to save 80% of the original fee estimate. It's very difficult to estimate the cost of a due diligence exercise because so much of it depends on the specific transaction and the specific company. Each one's going to have its own issues. Broadly speaking, the bigger the company, probably the higher the cost. The more the company has land, building, and other assets, probably the higher the cost. If we give a generic example of a middle-sized company, the likely total due diligence cost might be something of the order of $50,000 to $100,000. Another rough rule of thumb that's used is to estimate the total costs at between 1 to 3% of the deal size. This includes also the contractual costs of drafting legal documents. The management of the cost of due diligence is also complicated sometimes. The consultants hired are usually paid on an hourly or daily basis, and their tendency is to try and maximize fees by proposing more work than may be strictly necessary. Therefore, the investor needs to understand the relative importance of the different parts of due diligence and sense what areas are the most difficult ones which need more in-depth analysis. And often the two-step modular approach is best by commissioning a consultant to do a phase 1 due diligence, examine the results of the phase 1, and then proceed to phase 2 of due diligence if the results suggest further work may be necessary. But ultimately, managing the due diligence process is part of the experience that any investor should potentially develop. Another one of the issues that will be discussed is the question of who pays for the due diligence costs, whether this should be the investor or the company who's potentially receiving the investment. Question 1. Which type of due diligence reviews the company and its market? Please select one. A. Legal due diligence. B. Accounting due diligence. C. Technical due diligence. D. Business due diligence. We now turn to the specific question of sell-side due diligence and the benefits for the company and for potential investors in the company. Let's start by summarizing the specific benefits to the company performing a sell-side due diligence. A level playing field in the bidding process. Potential investors can submit bids with more confidence, and that leads to reduced ability by the investors to renegotiate on price and terms later, which is something to the benefit of the company. Minimize surprises. Being upfront with the issues discovered in a sell-side due diligence will enhance the credibility of the seller and will lead to a better negotiation, which is built on more trust and more willingness by the investor to trust the seller's representations. Proactive corrective measures. If one identifies a problem during a sell-side due diligence, you can report to the buyers that steps are currently underway to correct the issues identified, and that will have the effect of minimizing their impact in negotiations and therefore leading to a better deal for the seller. Accelerating closing. Sell-side due diligence will help to streamline and reduce the cost of a buyer's due diligence, which will have the effect of attracting more buyers and increasing the options available to the seller. Some other more secondary advantages to the players involved of a sell-side due diligence is, in the case of a standalone business, a sell-side due diligence can pull all the company information into a single comprehensive document which provides a roadmap, helps to build the data room, and identifies area of concern. And this can be particularly helpful in the case of a division that's been put for sale that doesn't have its own autonomous set of accounts. Divestiture. Divestments have an added layer of complexity due to the central functions which are not within the division. A sell-side due diligence can highlight cost structures, contribution margins, cost allocations, and the balance sheet carve-out items. So it makes it more easy to understand what needs to be done when you carve out a division in a divestiture. Advisors. Well, the main objective of advisors is to maintain control of the sale process in order to maximize value for the seller and reduce the risks. If the issues have already been vetted, analyzed, and identified by a sell-side due diligence, the deal process is more effective and the so-called landmines are not present within the company. For investors, they will have a better understanding of the company's financial information much earlier in the process, which is very useful for them and for the seller. This will result in a more competitive bid with more confidence and less caveats, because the buyers will be sure that there'll be no surprises later, and the investor can then focus his attention on the most attractive deals. And having a good sell-side due diligence makes a deal more attractive for an investor. We present in this slide a case study of a sale without due diligence, which concerns Panini, a major trading cards company based in northern Italy. Panini was put under administration, which is a procedure similar to Chapter 11, as it's known in the US, under which it's administered by a court. And the mandate of the administrator was to organize a quick sale of the company and then pass on the proceeds to the creditors. And because of the legal requirements of the procedure, it was impossible to allow any sell-side guarantees. And that included no sell-side due diligence, because that was not allowed by the procedure. And therefore, the bidders' due diligence, which was performed by them and not shared with the sellers, gave them an actual information advantage, because it turned out that they ended up knowing much more about the company than the administrator of the company, who was there mostly focusing on crisis management. Panini was therefore then sold to a private equity group led by Bain, who paid 15 million euros for the company and then was able to resell it after only 2 years for 110 million. Here is another example of Exim Banker in Serbia, and this is where a very thorough sell-side due diligence was performed. Exim Banker was an SME bank in Serbia. It had been acquired by a private equity consortium led by Soros, and the strategy was to sell the bank after a number of years to a major Western group. The preparation for sale included sell-side due diligence reports, the preparation of electronic data room, a board member acting as the project manager of the sale, and giving actual training in presentation skills to the management. This allowed for a very competitive sale process and a lot of interest by bidders, and eventually it was sold to Bank Austria for 2.5 times book value, and the investors enjoyed a profit of 90%. Let's look at sell-side due diligence from another point of view, as a signal to the market. Commissioning a sell-side due diligence sends a signal to the market that the company is serious about the process of acquiring an investor and wants to be transparent. Many companies or entrepreneurs will enter into negotiations out of curiosity without any serious intention. The fact that people see that an investment has been made in a sell-side due diligence acts as evidence of seriousness. A sell-side due diligence can also reduce significantly the time and the costs of the investor's due diligence, and therefore the investor will be more willing to engage into negotiations with this company. And thirdly, the sell-side due diligence will allow any advisor to go to the market with more enthusiasm and confidence that the deal will go through. The advisor's job is partly as a promoter, so their job is to go and sell the potential investment to potential buyers. If they know their backs are covered, if you will, because the company, there won't be any surprises, they will go out with that much more enthusiasm and dynamism into the market. Ultimately, it's about credibility. If we think about the level of credibility at different points in an investment transaction, seller credibility tends to be at its highest when the investor first gets information in the company. Introductions have been made, the seller has been presented. Then we move forward in the transaction. If discrepancies and surprises come out, so things are not as presented, the credibility of the seller reduces or may evaporate to zero. In the case of it evaporating to zero, it's likely the buyer will walk away. So at a certain point, if credibility is reduced too far, the investor may walk away because they don't have confidence in the process. What's important is that the business description, the sales, the cost, and the profit figures must hold up throughout the investor's examination. The biggest mistake that is made in the preparation phase by the sell side is to create a rosy picture to entice investors in the hope that the rest of it will somehow work itself out, or perhaps the investor won't discover everything. This is an illusion, it's naive, and all it will do is waste everybody's time. The golden rule in investment and in sell-side due diligence is no surprises. Let's now look at sell-side due diligence from the point of view of it serving as a roadmap to facilitate the buy-side due diligence. Sell-side versus buy-side due diligence. Sell-side due diligence is normally commissioned on the expectation that a buy-side due diligence will be coming in the near future. In other words, sell-side due diligence is commissioned because we're anticipating an investment transaction, and an integral part of any investment transaction will be a buy-side due diligence. The investor will not rely on the sell-side due diligence because it's being performed by the seller. The investor will rely on his buy-side due diligence only. Therefore, the objective of the sell-side due diligence are necessarily different from the objectives of the buy-side due diligence. The objectives of the sell-side due diligence are specifically, one, to increase the interest in investors in engaging, because knowing there's a sell side that's being performed, they're less likely to waste their time. Secondly, to make sure there is no surprise the seller is unaware of. It's very embarrassing for a seller to discover a problem in their company they didn't know about themselves. It makes them look very weak in the eyes of the investor. And thirdly, to act as a roadmap for the buy-side due diligence, therefore reducing the cost. The investor will see the main areas they need to investigate much more quickly if there is a roadmap provided by the sell-side due diligence. Let's make a brief comparison of buy-side and sell-side due diligence as typically found in a typical transaction. In terms of the cost, the sell-side cost, because it's a more simple exercise than the buy-side, a kind of preparation, if you will, for buy-side, the cost of the sell-side due diligence would typically be maybe 20 to 25% of the cost of a buy-side due diligence. In terms of the accounting side of it, a sell-side due diligence would generally be a limited review with in detail follow-up only if something was discovered, some red flag emerged. On the buy side, it would most typically be a full audit or a partial audit, and it may be performed in 2 stages. Legal due diligence, it will be limited to a limited review and then an analysis of known issues which are already present in the company. In the case of the buy side, it will be a standard review for fiduciary reasons. The lawyers will work through a checklist, and it's their duty to make sure they've identified all the issues. So the buy side will be a more structured exercise. On the technical side, the sell side, there may be a due diligence done usually to justify valuations of technical equipment. In the case of the buy side, the technical due diligence may be done by an external expert or the own staff of the buyers. And it's often frequently the case there may be differences in opinion on the buy side and sell side due diligence, particularly as concerns the valuation of technical assets. On the turn of ESG due diligence, on the sell side, it's typically not performed particularly, except for a very simple environmental review, often because of the lack of know-how on the sell side. On the buy side, it's more of a trend. Some investors will do it just environmental. Some investors will do a full ESG. It will depend on the type of investor. And so the ESG side is a bit more loose in this case. Question 2. What are the objectives of sell-side due diligence? Please select the relevant ones. A. To act as a roadmap for buy-side due diligence, hence also reducing its cost. B. To tick the box. C. To make sure there is no surprise the seller is unaware of. D. To spend money. We're now turn to the question of due diligence cost management and apportionment. So one of the big issues here is who pays the costs. And the question of who pays due diligence costs can become a very important issue during any transaction and can actually be a source of a great deal of irritation and conflict. Due diligence costs. Due diligence costs are frequently a sensitive question and can become the object of a great deal of negotiation during any transaction. The argument on the side of the seller for the investor to pay is, well, you wanted due diligence, you should pay for it. Now we're referring obviously to the buy side due diligence. The sell side due diligence costs are automatically paid by the seller. The argument on the investor's side for the company to pay is, one, well, if you want my money, you'll have to pay, otherwise I'm not going to invest. Secondly, the results of the due diligence that we perform on the buy side will create value because we'll share these results with you, and you'll be better informed about your own company than you were previously. And the third argument for the company to pay is, well, if this due diligence exercise is shared with you, it will save money on future audits and other type of corporate governance work, as some of the work has already been done in advance. And it's typical in the market for there to be some kind of compromise where the due diligence, buy-side due diligence costs are split, with many different combinations being possible. One other very important question when we are talking about buy-side due diligence costs is whether the due diligence costs, especially in the case of a broken deal, in other words, a deal that doesn't proceed, are paid by a private equity investor from his fund budget or from the budget of the management fees of his fund management company. And it's quite useful for an entrepreneur or a seller to find this out, because if the due diligence costs are paid by the fund, the investor will be less sensitive about the costs of his buy-side due diligence. If the costs of the due diligence are paid from the management fees of the private equity investor, the investor will be much more difficult as regards having to pay his share of fees. Let's examine now consultants and advisors who work in due diligence and broking of transactions in the private equity space. We'll look at the types of consultants, the way their fee structures work, and the main risks that occur when consultants and advisors work with entrepreneurs on private equity transactions. There are several types of investors that we can find in emerging markets, and this is pretty much the same in every emerging market, ranging from Central Eastern Europe to Latin America. You have investment banks, which tend to operate in the larger size of the market, and it's very unlikely in the mid-cap space that these will be present in any recognizable form. Then we have accounting firms. Accounting firms primarily will be looking at transaction support, but some accounting firms may have a unit dedicated to broking transactions, a kind of M&A type advisory unit. Thirdly, we have management consultants of different types who will operate in the middle market, either as deal brokers, but also sometimes as transaction advisors. They might advise more on the business side of the transaction. And then finally, small boutiques and individuals who will operate in the small or middle-sized segment of the market, often on a success fee basis, and they tend to have much more limited resources and tend to act mostly as brokers. The nature of the advisory relationship with the consultant is very specific because of the one-time nature of the transaction. So it's a one-time transaction, or at least an investment transaction company will occur only every few years. It's not ongoing operational type involvement. The transaction can be very critical or even existentially essential to into the company's existence. In other words, this investment is really going to change the company and has a very high risk. So what is required? There has to be a very high degree of trust on both sides of the seller and the advisor working for the seller. And what tends to happen because of this high degree of trust and the level of confidentiality and importance is that the advisor selection tends to work very much on the word of mouth and on the track record, because it's not a decision to be taken particularly lightly. What are some of the pitfalls that may occur? So from the point of view of an advisor interested in securing a mandate to work with a seller for an investment transaction, we have certain risks that may come forwards. The first one is unrealistic expectations. The owner of the business may have ideas which are not realistic about the valuation of the company, about how the company would be managed post-investment, or about the deal structure. The second risk is so-called cold feet. The seller is committed to the deal proceeds, everything works smoothly, the sell side due diligence, the buy side the negotiation, the deal reaches a very advanced stage, but just before the final closing, the owner decides at the 11th hour that he has changed his mind and is not ready to go through with it, with a consequent damage to everybody in terms of in terms of costs, reputation, and time. And another risk is bad faith. The owner has no real serious intention to going through with a transaction, but is looking to get an education about financing, or is looking to get a check for the value of the company, perhaps with a further purpose in mind. Some of the other things an advisor on the sell side may discover is the last resort syndrome. The owner has tried everything else, bank financing, other investors, and comes to the advisor once he's exhausted all other possibilities, therefore giving the advisor a difficulty because of the reputation of the deal in the market. Free materials. The owner is not looking to do a transaction, but wants to make use of the advisor to generate materials and know-how of investment, potentially for another negotiation, which will not involve the advisor. Free introductions. The owner is looking to the advisor to establish connections with others, or PR. The owner simply thinks making a little bit of noise in the market about being up for investment will raise the profile of his company, even though there is no intention to proceed. And these are all things that happen very frequently. One of the best ways for an advisor to reduce the risk of a potential sell-side client is to establish what the objective motivations are to seek an investor. And these can be divided into negative motivations. The seller, the shareholder is distressed, financially distressed, the company is distressed, there may be a conflict among shareholders to do with money or other issues, or family type conflict. It could be a neutral motivation, a succession issue, the owner is of a certain age and there's no children to take over. It could be to do with personal circumstances, such as a health problem. It could be regulatory and legal, that there's a legal requirement to transact. Or it could be a positive motivation. So the company has found a potential acquisition of a competitor and would like to proceed with this acquisition and requires funding to do so. Or a general ambition to grow the company organically and or by acquisition, where there is a vision for the future which involves giving up some ownership. So the fundamental part of an advisor's due diligence prior to accepting any assignment is to establish clearly the motive for the owner to seek an investor. What is the real motive rather than the presented motive, because there can be a difference. This will also impact the nature of the arrangements, contractual arrangements between the advisor and the seller, and it will also impact the dynamics of the deal going forwards. So let's look at some of the fee components that would make up of a transaction, particularly from the point of view of the fees charged by the advisor on the sell side to the entrepreneur or to the company. Firstly, costs. So reimbursement of out-of-pocket costs such as travel costs, communications, accommodation, printing costs. These may escalate, particularly if there's international travel involved. Retainer. It's customary for an advisor to seek a payment of a fixed fee to cover the work performed in preparation of a transaction, such as a teaser, an investment memorandum, financial model, contacts with potential investors. A success fee. This is a fee that would be paid in the case of a deal closing based on the conditions of a transaction, so paid in cash as a kind of commission. And then third-party costs. There may be, apart from the financial advisor, there may be fees incurred to pay supporting consultants like accountants and lawyers, who may be either subcontracted by the advisor or contracted directly by the company. Some of the main issues with advisory fees that we find from experience is one or two items. Firstly, an unwillingness on the part of the seller to pay any costs or retainer fees, so commission only. Well, this is a problem for some advisors, which may lead to no agreement being reached. But if there is a choice made to proceed, the way these can be mitigated is to rely on the owner or the historical advisors, like the accountants of the company, for preparation of most of the materials, and reducing one's involvement to just reviewing these. Reducing the essential costs of travel, not doing any
any international travel. The risks of that is that the sell-side due diligence will not be done properly, the quality of the materials may be poor, and this will lower the chance of a successful deal. Another issue is non-exclusivity, that the advisor is appointed on a non-exclusive basis. The way this can be mitigated is to agree a limited number of advisors and agree a list of the investors to contact so that the same investor is not contacted by 2 or 3 different intermediaries. The main risks is that the deal will complete with another advisor with a consequent loss of earnings, or it could be that the deal collapses as the buyers pull out because of the confusion generated by different advisors competing with each other. In most markets, it's better to have quality clients, and that part of having a quality client means exclusivity and some form of retainer. From the point of view of the sell-side advisor, there are some ways the fees can be structured to better align the interests of the advisor and the seller, and to make the seller more amenable to paying such fees. Firstly, the retainer. It's possible to make the retainer paid against deliverable milestones, such as production of a teaser, of a memo, of a due diligence report, of a financial model, or of a list of investors. The retainer could be paid on a monthly basis for a limited period, and the retainer could be offset against any success fee. The success fee, the fee can be based upon achieving a minimum price. There could also be a ratchet mechanism, with the fee increasing proportionately with valuation. Other features can depend on deal aspects, such as minimizing funds in escrow, minimizing guarantees on the seller side. Costs. One structure could be an agreement on an all-inclusive cost budget, or an agreement on a cost policy, travel, hotel classes, or prior agreement on incurring of costs, such as for a foreign trip. There are some techniques to enforce or to guarantee payment by an advisor, or to minimize the risk of not getting paid. One is advanced monthly payment of retainer. The second is direct payment of expenses, so plane tickets or hotels are prepaid by the company. Periodic payment upon delivery of a deliverable, such as a report or a teaser. And for a success fee, part of the deal structure could be instructions to the payment agent or the bank or to the escrow agent, so that the success fee is paid directly from the buyer directly to the seller as advisor, rather than to the seller, and then the advisor having to get his fee then from the seller, who may then be tempted not to pay it. Question 3. Which are considered risks for an advisor working on a deal? Please select all relevant ones. A. Unrealistic expectations. B. Bad faith. C. Cold feet. D. Last resort. The first example of the case study is Elcon in Italy. This was an industrial controls manufacturer based in northern Italy, in the very specialized area of engineering. The founder, who was in his late 50s, was looking for liquidity, personal liquidity, a change in lifestyle, and moving on to a less demanding role, and eventually exiting the business to change his lifestyle. His main motivation was maximizing the price. The advisor, MMR, which was a local Milan-based boutique, entered into a success fee only arrangement with an upside ratchet. So they received a 2% success fee on the proceeds up to a certain level, and then 5% on any amount above that. There was no retainer or cost refunds. So MMR prepared a fairly basic package and targeted a limited number of companies who were already operating in the sector and who already knew the industry, and therefore it wasn't so important in this case to do a very detailed sell-side due diligence. When foreign trips were necessary, what happened in practice was that the MMR would say to the founder, well, we're not going to come along because we're not being refunded, and then the founder would end up paying for them because he didn't speak any English. Finally, the company was sold for a consideration of $12 million, and MMR earned their fee. This is another example. This concerned a school project in the Ivory Coast in Africa. A group of parents were all working for a major bank, and they approached an advisor to advise them on fundraising for creating an international school. The pupils will be guaranteed because of the strong interest of staff of multinationals and the banks for sending their children to such a school. WCL insisted on a fixed monthly retainer payable in advance, plus prepaid costs, with success fees to be agreed at a later stage. A few months into the project, divisions within the sponsor group emerged on a multiple range of issues, including the fees, and led to WCM withdrawing from the project. So WCM was able to get paid for its basic work and cover its costs. And the reason WSM insisted on the advance fee was that they felt the client was a risky, divided client, and the client did not have clear ideas about what they wanted, and so they had to make sure that their costs and their retainer were secure. This was a case of the Serbian Privatization Agency. This was an agency of government under the Economics Ministry, which was created under the auspices of the World Bank, and part of the money provided by the donors was also to fund retainers of sell-side advisor, which were chosen by the agency through a competitive tender. The tender process was a point system which heavily favored the lowest cost bidder, and many of the companies being privatized were quite unattractive companies, and they also came with strings such as an insistence by government that the jobs would be preserved. So many of the tenders, in fact, what happened was many of the tenders were won by second-tier consulting firms whose only real interest was the retainer, and they had no real belief that there would ever be a success fee or there would be a successful transaction. And therefore, having won the tender, they then minimized their costs by putting the most junior people on the job to prepare very low quality materials in order to get their retainers paid according to milestones. And no real credible effort was put into selling the companies, and many of the transactions ended up failing. So the moral of this one is pay peanuts, you get monkeys. Here is an example of a buy-side mandate. This was CAIB, a well-known regional investment bank based in Vienna, was mandated by Heidelberg Cement to help them with acquisitions in Central Eastern Europe. CIB was required to conduct very thorough professional analysis, and this was a material that had to be quality enough that would be able to be put to the board of directors of Heidelberg. And so CIB dedicated their very best people to the project. They were paid a substantial monthly retainer plus a small success fee. So these projects were interesting for CIB because they provided a very good regular monthly income, contrasting some of the more success fee based projects. And CIB was also able to develop very strong expertise in the cement sector. So a strong client who always pays on time is an essential part of any M&A consultant's portfolio. One thing that one has to be careful about is what transaction is, how it is defined, because this will also determine whether an advisor gets paid a success fee. And from the point of view of the owner, it may be important to limit the definition of transaction to the transaction the owner is seeking to accomplish for which is retaining the advisor. From the advisor's point of view, the advisor should be careful about limiting the definition because the deal structure could come out in a different way and they may affect the fee. So a sample definition we give here means we have an all-encompassing definition of transaction, so that may include not just considerations paid on the date of the closing, but also further commitments to be made in the future. Some of the key things to look at in advisory agreements: one, clauses exclusivity. Typical, it's best practice that M&A engagements should be exclusive. We've seen earlier the problems of non-exclusivity, and also entitled advisor to fees after the term of the engagement, because it's possible that the advisory agreement may terminate and then shortly afterwards the transaction closes. So there would be something known as a tail period in order to capture that. The company may, as a quid pro quo for exclusivity, ask the advisor not to represent any other entity involved in the transaction, because it has been the case that advisors may get paid from both sides of the transaction. The term of engagement would either be indefinite or a period of at least a year with some renewal clauses. There may also be clauses to allow the advisor or the client to terminate the agreement, with obviously certain provisions surviving termination, such as earned fees, expense reimbursement, tail period rights, indemnification, confidentiality, and the choice of law and forum. Regarding success fees, one of the things that may require careful consideration is defining what we mean by consideration. So the actual volume of money which will be used to calculate the success fee, and that can sometimes be difficult. And so particularly careful attention should be paid to the details of this definition and its applicability to any transaction, because this can lead potential conflict with the seller arguing that it should be a reduced scope and the advisor arguing that it should be more. We give here a legal definition which may be used in advisory agreements. So looking at what consideration could potentially include, this would be obviously cash. It could also include the stock or the shares of a purchaser. It could include adjustments in working capital. It could include assets that are retained by the business. It could include rolled over equity. It could include purchaser notes instead of cash. It could include earn-outs, in other words, amounts that are paid contingent on future results. It could include debt, so third-party or bank debt assumed, repaid, forgiven or refinanced, capital leases and other contingent liabilities. So careful care must be done to define consideration. One important clause of any advisory agreement is the tail period. The tail period is a specified period of time after the engagement is terminated, during which, if the transaction is completed or agreed to and subsequently completed, the advisor will be paid a success fee, despite the advisory agreement having expired. This eliminates from the seller's incentive to terminate an advisor prior to closing and then close the transaction in order to avoid paying a success fee. It protects the advisor if the parties decide to restart the transaction within some period of time after a first termination. It's usually triggered only if the transaction is done with a party with whom the advisor identified, signed a confidentiality agreement, or with whom the advisor had substantive discussions. Two other important clauses we may find in M&A advisory agreements. Breakup fees. These are fees which are payable if the transaction does not occur for any reason, especially if the client simply changes his mind and withdraws, and if the seller is paid a breakup fee by the potential purchaser. It generally consists of a percentage, sometimes around 20%, of the potential success fee or the breakup fee received by the seller from the purchaser. Indemnification. All engagement letters will contain some form of indemnification for the advisor and its employees and or agents. It's generally drafted so that the advisor will be indemnified for any liability it incurs in connection with engagement, other than for a liability resulting from gross negligence or willful misconduct on the part of the advisor themselves. A few key general points to make about advisory agreements between seller and a broker. The engagement letter should be structured to reflect clearly the understanding, the expectations of the parties, and not avoid issues that may be sensitive between them. It should properly identify the client and the beneficiary of the services. It should include appropriate disclaimers and other contractual provisions to limit the liabilities and the obligations of the advisor. It should vet and assess potential conflicts of interest and put in place processes for their management. It should give thought to provisions for the enforcement of collection of fees and expenses, for example, by embedding these into any deal structure. One of the questions that comes out is an M&A advisor or a broker of an investment transactions really performing a useful function? And there sometimes is some negative publicity about this, presenting them as kind of a low-level commission seekers. But these a professional and quality M&A advisor does have an important role to play in the economy. They help to provide liquidity to small and private businesses. They create a marketplace between SMEs, strategic investors, private equity funds, developmental banks, and professional service providers. They help to act as a catalyst for foreign direct investment in emerging markets. They help to disseminate financial know-how and culture in emerging markets. It is true that in emerging markets the profession can be less organized and regulated than in developed markets. It may take on a project risk that other professional advisors who are more oriented towards being paid on an hourly basis are unwilling to take. And the value is also created by synergistically managing the delivery of different but interrelated business and financial advisory services, such as business valuation, strategic growth planning, business performance improvement, corporate finance, M&A advisory, personal financial planning, wealth management, accounting and tax, legal estate planning, government relations, and lobbying. A good M&A advisor may touch on all these issues in one transaction. Best practices in due diligence. Here we review some of the best practices in due diligence. The first question an advisor should ask themselves is to understand the relative importance of the two main motives for a due diligence report. One is identifying the issues, the substance of the issues, and secondly, that the commission of the report, the client wishes to have a report with a brand name on the cover for the file, for his board, or for the other stakeholders. When reviewing the corporate structure and the governance, the process is to review documents and interview the management, the board of directors, and other advisors. Some of the questions that should be considered: what is the company's corporate structure? Does this model allow for a liquidity event and or return on investment? Is there an exit strategy? Who are the shareholders? Does the corporate structure fit with the business model? Does the corporate structure allow for growth? Who is on the board of directors? Has the company been involved in any litigation? Does the company have all the required permits and licenses? Regarding the financial assumptions and the revenue sources, one should review all the financial documents. Some of the questions that should be considered are: has the company completed financial projections? Have the financial documents been properly developed according to applicable accounting rules? Has the company used an independent accounting firm? Are revenues realistic? Has the company already received funding? And if so, how much? What are pre-money valuation and terms? What are the following funding requirements and sources? Have all the tax returns been properly filed? What is the company's debt carry? What are the ratios? Is the company's current valuation aligned with its current stage of development and market potential? Market assessment. As part of due diligence, one should do an independent market analysis and require customer references if applicable. Some of the questions that should be considered: does the company's product or service address a new or existing market? Does the company have a well thought out sales and marketing plan? Does the company have key relationships in place? Has it chosen the right first market? Does its product or service represent a market push or pull? What is the potential market size? What is its stage of development? What is the length of its sales cycle? Does the company's product or service have a seasonal aspect? Is this a stable market, and are the costs of goods sold stable? Competitive arena. As part of due diligence, one should also do an independent competitive analysis. Some of the questions that should be considered are the following: who are the company's competitors? What is the company's market differentiator? What does the market share look like? How will this company win its market position? Has the company done a detailed feature-by-feature analysis? Management team. As part of the due diligence, it's essential also to interview all the team members and the key employees' references. Some of the questions that should be considered: what is the caliber and the pedigree of the team? What is the team's overall track record? Does it have the required skills and experience? Is the management open to improvement to its business model? Has the management team been previously funded? How are management and all the employees being compensated? Technology assessment. We may need an expert or professional assistance in assessing the technology, particularly in the case of companies using advanced type technology. Some of the questions that should be considered: does it have market requirements and functional specifications? At what stage is development? Does the company have any usability studies? Does the company have adequate intellectual property protection? Does it need it? Is the company relying on being first to market rather than on any independent position for competitive advantage? And is this realistic? What is product quality assurance like? Is it proprietary architecture or open source code? Some of the questions that should be considered when considering operations: does the operating plan anticipate growth? Is anticipated growth realistic? Has the company considered all aspects of operations to successfully launch a product or service? Has the company received any citations or notices of violation? Does management meet regularly to ensure compliance with plans or make needed adjustments? Does the plan take into consideration all cash needs and anticipated cash flow? Does the company have an alternative plan if assumptions do not hold anymore? Some of the red flags that may emerge in due diligence: unrealistic valuation of the company or an unrealistic revenue model which way overestimates revenues, as is particularly the case in the technology sector; complicated investment terms; heavy debt, the company has a very large amount of debt; missing key assumptions about the market or financial model, a company that's a one product or service company, no board of directors or a board of directors that is obviously not functional, inexperienced management, and poor advisors. And these are all things that can be seen very quickly at an early stage of a deal, and therefore it's possible for the buyers to withdraw at an early stage as well. Question 4. What could be considered a red flag when the due diligence is performed? Please select all relevant answers. A. Missing key assumptions about markets or financial models. B. No board of directors. C. Skilled management and employees. D. Poor advisors.
We here provide an example of a due diligence checklist. We will discuss in a second what this is for, but we need to make a statement that the World Bank hereby assumes no liability for the accuracy or completeness of such a checklist, and everybody should rely on their own advisors. This checklist is used by private equity fund managers in order to go through a company to see all the main elements for the due diligence. And so this is what you would expect if you were a sell-side advisor of the company, that the areas that the investor would be focusing on. Therefore, it's important to understand where they're coming from, and any sell-side due diligence should be structured in a way as to be able to address all the different categories which are included in this checklist, or at least to provide a pathway for them to be able to perform their due diligence effectively. So the best starting point for any advisor to the company is to look at the checklist used by a PE fund, and then look at the categories which can easily be addressed, and this will help inform the planning of the sell-side due diligence.
This is a typical situation any potential investor may face. They've performed a due diligence and some half dozen irregularities have emerged, and now the investor has to decide whether these irregularities are not relevant at all, whether they require an adjustment to the transaction, or whether they're so serious that it's a deal breaker.
So finally, I would like to express my thanks to the World Bank for allowing me to share a version of the course that I developed with them and put it online on my website, on my LinkedIn profile. So thanks for that. Secondly, all the modules, this module and all further modules, will have a certain amount of case studies and additional materials attached to the module, which are part of the learning experience. These materials I will be posting on a specially created group that I have made in LinkedIn called Gavin Ryan PE Course. All you have to do is search Gavin Ryan PE Group, and the group will come out for you to join. You who are following this course, you'll be eligible to join my group and get these additional materials once you've connected to me on LinkedIn and once you've subscribed to my YouTube channel. So when I receive a request to join this group, I will check these two things and then I will admit you to the group. So thank you very much for your attention. I hope you've enjoyed this module, and I look forward to seeing you on the next module.